Next portion is very serious business. It's about money. It's about banking. It's about finance. It's about forecasting for 2013. We are very fortunate in the ABA to have Frank Sorrentino, Chairman and CEO of North Jersey Community Bank. He is also a financial expert and shares his knowledge with CNBC and Bloomberg News and TV and radio and Fox Business News. So he has all the answers that we are seeking, and you're guaranteed to be very wealthy when you come out of here. So without further ado, and perhaps most importantly, of all those titles that he has, he's a member of the ABA, and I'm very proud of that.
So thank you, everyone. Thank you, Bob. Thank you all for taking the time this morning to wanting to listen to what I may or may not have to say about the economy. I'm not a financial expert. I'm not an economist. I am guilty of being the chairman and CEO of North Jersey Community Bank, and one of the perspectives, and I'm joined by some of my lovely staff members here today, Jahan and Sia, sitting in the fourth row. But one of the perspectives that I have, which I think offers a unique perspective for you, for all of you, is that we opened our doors in 2005, and since then, we have consistently been, for the last 7 years, the fastest growing bank in the state of New Jersey. And we're one of the top 5 most successful community banks under $5 billion in the country. And if that's not just a sales plug for myself, I use it in trying to create a context for the conversation. Think about the time frame that we're talking about growing a financial institution, God bless you, growing a financial institution. And not just growing it, but growing it successfully, profitably, and with metrics that the other almost 7,000 banks in the country would just be incredibly envious or jealous of. The context of the time frame from 2007 through to, actually even through to today, has been one of the most difficult financial periods in our country's history. And so we represent today something like 4,000 business owners, just like yourselves. And so we get this perspective to look at what each of those 4,000 companies are doing, how they're doing it, which ones are succeeding, which ones are doing well, which ones aren't doing well. And so we'll talk a little bit about that here today. So a couple of the topics I'd like to sort of cross over today, but clearly anybody who has a question at any point here, please guide me in the direction that you want to go. But I thought I'd talk a little bit about the banking environment itself. I thought I'd talk a little bit about the financial environment, and we're going to talk a little bit about interest rates, because to me that's a very important topic here today, and it's sort of tied into what's happening in government. The regulatory model that's coming up and what you can expect in that banking industry, and how is that going to affect your business going forward. So that's sort of where I want to go. So as I said before, as we sit here today, there are about 6,800 and some odd banks in this country. About 90% of those banks are small community banks like ourselves. There's about another 50 or so regional banks. And then there's the top dozen or so of the largest banks in the country who got even larger in the financial crisis. The country always didn't look this way. 20 years ago, there were 16,000 banks, and there were no banks that were significant institutions, meaning that they were too big to fail. Well, today we have that. We have institutions that are in fact too big to fail. We live today in an environment where, because of the policies of the Federal Reserve, because of government policies, because of Dodd-Frank, because of the ills that did accumulate over the last 20 years, we've put in motion a set of policies that have caused for the shrinkage of the banking sector, the banking space. And so 20 years ago, 16,000 banks. Today, less than 7,000 banks. Tomorrow, 4,000 or 5,000 banks. And that's going to affect everybody in this room, because two things are happening there. It's sort of like a barbell. So you have less community banks, less banks like ours. And so you have less opportunity to go to places where people truly understand your business. And you have this accumulation of assets in the largest of institutions where they just can't deal with small business owners. They try to, they want to. They have great programs in marketing that says, small business banking program. They assign people to be team leaders and want to come into the community. Some of them even call themselves community banks. But at the end of the day, they create their products based on an algorithm. You either fit, you don't fit. If you don't fit, you don't do the business. And so you have these two areas of banking that are both moving away from the small business owner. And to me, that's a pretty dramatic direction that we're going in. And I think it's important for everyone here who is in any way, shape, or dependent upon financing, debt, to take that into consideration, to understand where you are today, what direction do you think the financial institution that you're doing business with is going. Are they going to be there tomorrow to satisfy your needs? And let's talk about tomorrow a little bit. So the interest rate environment today, let's shift gears a minute because this is important. Is there a marker here?
Hi.
So there's an interesting graph that I always like to look at. It'll sort of set the stage for where we are today. So if these are interest rates and 0 is the baseline, and I think the highest interest rates we had in this country were around 20%. And if you started where the country started with a banking system with the 1780, and we move forward here to 1980 and to today, you would see a graph that looked something like this. And I purposely drew this line below the 0 line. So for all of known history, interest rates have been sort of floating around this 5 to 6% range. There have been a couple of periods in history where we've had interest rates in the 8 to 10% range. In the late 1970s, which culminated in 1980 or 1981, interest rates went to 21%. And basically from that point, and there are some ups and downs in this graph, but from that point through to today, they've gone to 0. I'm talking about the Fed funds rate here. This is the overnight borrowing rate. And by the way, if you looked at the 10-year Treasury, or you looked at any other rates, you would see a similar type graph. We sit here today in this room in a period of the lowest interest rates in history. And I drew this line below the 0 line because the way the Fed has structured its balance sheet, for those of you who aren't following the news, the Fed's balance sheet 4 years ago was about $700 billion, the whole size of the Fed's balance sheet. Today it's approaching $3 trillion. They've tripled the size of the Fed's balance sheet. What was the purpose of doing that? What they've done, the Treasury goes out and issues bonds for the US government. The Federal Reserve, which is the bank for the United States, went out and bought those bonds. We're not supposed to be doing that. We're supposed to be buying those bonds. The fact that they bought $2 trillion worth of debt drove interest rates down to this low point. Why did the Fed do that? Well, the Fed did that because we've gone through the greatest recession since the Great Depression. And Ben Bernanke is a student of the Great Depression. One of the problems during the Great Depression is when it happened and unemployment went to 22%, the government got the bright idea to tighten up interest rates, to clamp down on business, to clamp down on the availability of credit, which drove the economy into an even deeper spiral. And so the recession sort of started to end, the Depression ended in 32, 33, but then we fell off the cliff again in 1937 because of all these tactics that the Fed did. Well, Ben Bernanke learned a lesson and said, well, we're not doing that again. And so we're going to liquefy the economy and we're going to create this 0 interest rate environment. And so I keep alluding to the fact that this line is below here because I truly believe true interest rates today are less than 0. You're getting paid to borrow money, okay? So at our institution, the Fed has encouraged us to make loans by driving the overnight pricing of funding down so that we can't afford to keep money at the Fed. We want to put it out in loans. And so banks are out there trying to make loans. But I think one of the things you can sort of see, now this is 1780 to today, that's a lot of years. There's no other point in here where interest rates are down below this line. So what does that tell me? Just like this is a blip, this is a blip. We're not going to stay here. We're not going to stay in a zero interest rate environment. And my concern about this place where we reside today is that when it changes, it's going to change violently. Because some of the things that got us here and some of the things that have us held here will change very, very quickly. And they will not change in a very, very, slow, readable fashion as they've been changing over the last 30 some odd years. Yes?
What are those things that are going to change it?
Okay, so that's exactly where I was going next. So there are forces outside of the U.S. There's actually the policies of the U.S. So all of this debt that's been created by the government, that's being bought by the Fed, at some point has to be unwound. The Fed has to turn around and sell that debt. Well, when there's too much of anything, price goes down. The price of debt is inversely proportional to the yield. So if you buy a bond and the price of the bond falls, that means the interest rate goes up. And so as the Fed starts to unload its position, interest rates normally will have to rise. And all they would have to do is rise to a more normal place. I'm not even talking about anything extraordinary. So right now, a 30-year mortgage is at 3.25%. 30 years. You're locking up an interest rate for 30 years at 3.25%. There's never been a time in history where you could do that. Now, when I bought my house, I got married in 1984. Okay, 1984 is over here. My first mortgage was 13.75%. And when rates fell in 1987 or 88 to 9%, I refinanced my house, and I thought I was a genius. We had clients come into the bank not 2 or 3 years ago who were refinancing their mortgages at 5 and 5.5%. And the last time I can remember anybody talking about 5.5% interest rates was back when my father bought his house back in 1964 when he got a 5% mortgage. That was like, oh my God, the holy grail of the financial industry. Well, think about how far we are today, and think about the pricing that's been built into our system as we sit here today based on that 3% mortgage or the 4% mortgage. So what's going to happen to the value of assets as these interest rates even go to a normalized place? So people are struggling today to qualify for a 3.25% mortgage. What's going to happen when they got to take out a 5% mortgage or a 6% mortgage? And if I told you the economy was going back to 5 and 6% mortgages, your initial response would be, well, that's okay, but it's really not. That's the carry is twice as much as on a current mortgage today. And so for those businesses or those individuals who are basing where they lie today, I believe there's a true distortion in the economy here. So if you're basing your decisions based on the fact that you can get 3% money, you better think really, really hard about stress testing your scenario to say, well, what's a normalized interest rate and can I